So you're right in saying that actually there's quite a focus from domestic investors. If we look at the increase in activity, if we look at the volume of transactions across Asia-Pacific, it's actually overwhelmingly dominated by domestic capital, domestic investors buying in their own markets. And the proportion of acquisitions that are cross-border has fallen from 30% or so back in 2007, has fallen down to bouncing around in the sort of 10 to 15% range as we move through at the moment. Now, if we just take that cross-border component and split it out, so those smaller bars at the bottom of the chart, split that out, there's also a strong Asia versus the rest story, because not only is it domestic capital, but if you look at cross-border, it's principally Asian money moving around Asia rather than capital coming in from outside. So again, back in 2007, we were seeing a lot of global and North American funds coming in and buying into the region, quite a lot of European investment coming in. So about half of the cross-border flows were accounted for by international capital. Now, overwhelmingly, the cross-border flows are very much being driven by Asia-Pacific investors looking at their own markets. And I think this is the really key question. If there's a structural change going on in here, as opposed to just a short-term cycle, the real question is, historically, Asian capital, when it's looked to go cross-border, has not looked to move in its own region. It's tended to focus on Europe or North America, or not just trophy assets, but the big liquid markets. Now, with the very strong positive fundamentals and the long-term growth offered within Asia, is that Asian capital going to be more Asia and Asia-Pacific focused rather than moving elsewhere in the world? And we often focus on what's happening just from an acquisition point of view, but the picture's almost more clear if we look at net investment. So, of the cross-border holdings, what are cross-border investors doing? Are they, on balance, buying more than they're selling, or are they net sellers of their cross-border portfolios? And here you can see a very sharp distinction between the two. In the run-up, or immediately post-crisis through to 2009, both groups were still net investors generally, but on a declining basis. Then, from 2009, we've seen international investors, those from outside the region, continuing to sell, on balance, more than they're buying, principally driven by the ongoing unwinding of large international global funds or North American funds who have tended to need to raise capital and, in fact, are not really able to do so in many cases with their holdings in their domestic markets because they would be crystallizing losses they don't want to do. Asia is the one market where they've been able to continue to sell and realize a profit and recycle the capital. So, on contrast to that, Asian investors, having gone through a slower period, now starting to redeploy their capital around the world.
Yeah, I think institutional institutions in Asia have just become so big now, and there's so many of them. So you're really just at the beginning of what could be a great era of global and Asia investment from Asian institutions.
Absolutely. I mean, if you look at these emerging markets, one of the key features of them is the relatively limited scale of development, despite their absolute size in some cases. You know, the financial markets, the investment vehicles, the insurance funds, the investment funds that tend to comprise the stock basis of the default investors in many markets are still hugely underdeveloped. And if you think that we're starting to see some impact from Chinese capital, just wait. Because the big challenge that the Chinese government's got at the moment is controlling its house prices. Now, why are house prices going up so high? Well, partly it's actually underlying demand. In large part, it's simply because there's nothing else to invest in. If you have got family money, if you've got family wealth, most of it isn't actually hugely debt-driven. A lot of it is equity investment. You know, the stock market in Shanghai is just a casino. There's no bond market to invest into, and investment outside of China is extremely difficult. So if you're a bog-standard investor, real estate is the only thing that's left. What the Chinese government knows it has to do over time is increase the range of investment options so that there are different forms of investment rather than just going and buying another house. And when that process starts to kick into gear, just wait and see how much capital is coming out. We're already seeing it from the Koreans, and they're a tiny economy in contrast to China.
So really, it's not just a cyclical play, it's really a long-term structural change that's going on.
Absolutely. As I say, the key issue is, are they going to carry on buying London, New York and Paris, or are they actually going to be more active around the region? I mean, if we look at this on an individual country basis, then again we can see that pattern. This is sort of since the bottom of the cycle, so since the middle of 2009, how much investment acquisition activity has there been in each country and how much of that has been domestic versus international. And you can see in China, and again this excludes money going into Chinese development sites, it's just standing investments. You can see quite a lot of money flowing into China, but also into Hong Kong, into Singapore. Japan, very much more a domestic market.
Mm-hmm. Yep. So what about Japan? Let's focus a little bit more on investment there. And of course, earlier this year, after the earthquake, you've been there and done some research studies into the impact of that as well. And has it had any impact on capital flows to Japan and perhaps going elsewhere into the region?
Yeah, I mean, undoubtedly it has. I mean, you saw there that Japan is by far the biggest market in the region in terms of total size of investment activity, but attracts actually a very, very small proportion of international investment. If you look at where the international capital flows are going and where the money's moving around, you can see that Singaporean capital is very dominant in China, but also a significant component of what we're seeing elsewhere in the region. That probably it highlights a particular problem that we have in classifying nationalities of capital, because actually a lot of that isn't Singaporean money per se, it's the Singapore REITs, the very strong players, regional players that we see there, who are investing into all of the property sectors, but particularly office and retail around the region. We can see some European money moving around, but generally speaking, what we're seeing is a big internationalization, although a lot of the vehicles and the nationalities that we're seeing are capturing capital from different parts of the world. Investors investing internationally in many cases now recognize that they don't necessarily have the expertise to know and understand all these markets in detail, so they're investing with specialists, whether they're quoted REITs or other forms of investment. And certainly one of the comments that comes from our colleagues in North America is that they think there's more Asian money and certainly more Chinese money than we see coming through in the direct investment market coming in, because it's coming in through bank funds and other types of vehicles. Japan represents a particular challenge, partly because of the structure of the market. There's no shortage of desire to get into Japan. It's just that it's a tight market controlled by a number of big landlords and investors who tend not to trade on the open market. It's also, in comparison with most developed economies, it has a very opaque market. There's not a lot of information, and it's difficult to access and difficult to understand. In the run-up to the earthquake in March, we were seeing very, very strong interest from international investors, not just on the fundamentals, but because even though yields were low, the very, very low level of interest rates and cheap finance made it an attractive market to look at. Clearly, after the earthquake, there have been lots of questions asked about what's going to happen. We've done quite a lot of work talking to investors and occupiers. On the occupational side, the impacts are, as you kind of might expect, people are a lot more focused on the earthquake protection qualities of particular buildings, in some cases saying that they will occupy those buildings at the expense, no matter what the rent. They're very focused on the specific local ground conditions and what the potential seismic threats are. In general, no signs that people are thinking of leaving Tokyo or are thinking of relocating out of Tokyo, although people are going to be investing and creating more backup facilities around. But in general, things starting to return to normal, albeit that inevitably there will be some impact coming through on the occupational market just because of slower economies and the disruption to the supply chains that we've seen. From an investment point of view, again, probably less impact than you might expect to see. In general, investors were fairly bearish about many of the different locations and sectors in Japan because the economy was still facing some quite significant challenges, with the exception of central Tokyo offices, where the market was becoming a bit more optimistic.